Hello guys, we have seen first method, that is discounted payback period method under discounted cash flow method. Now we are going to see the second method, that is net present value method. What is net present value? It is the excess of present value of cash inflow over the present value of cash outflow. So what is the formula for net present value? Present value of cash inflow minus present value of cash outflow. Okay, let's see an illustration 9 which shows the net present value method. EZ Limited has two projects under consideration, A and B, each costing 60 lakh. The projects are mutually exclusive. That means both projects are different projects. We cannot choose two at a time. We have to choose only one project, which we have to decide using the NPV method. Life for project A is 4 years and project B is 3 years. Salvage value nil for both the projects. Tax rate 33.99%. Cost of capital is 15%. So how we have to calculate the discount factor? Using the cost of capital 15%. Okay, cash inflows are at the end of the year 1, project A 60, project B 100, project and second year project A 110, project B 130, project at the end of the year 3, project A 120, project B 50, at the end of the fourth year project A 50. So present value factor, they have calculated the present value factor and given in the question itself, that is 1 divided by 1 plus 15 by 100, that is 1 divided by 1.15 power of nth period. If it is for first year, power of 1, second year power of 2, like that we have to calculate. We have already seen in the previous illustrations. Before solving the illustration, here we have to note one point, that is they have given tax rate 33.99%. I have already discussed relating to this. If tax rate is given, then how we will calculate the tax? We have to first deduct the depreciation and then only we have to calculate the tax. Here there is no depreciation detail given. If they have not given any method for calculating depreciation, we will assume a straight line method. So 60 lakh is the cost of the asset and life of the project A is 4 years. Salvage value is nil. So how we will calculate the depreciation? Cost minus salvage value divided by the life. So 60 minus salvage value is nil divided by 4, which is equal to 15 lakh. So 15 lakh is the depreciation for project A. And for project B, 60 divided by 3, which gives 20 lakh. So 20 lakh is a depreciation for project B. So we have to deduct the depreciation amount for all the year. That we will get profit before tax as 45 lakh, 95 lakh, 105 lakh, 35 lakh. So after this, we will calculate tax on the profit before tax amount. Then we will calculate then we will get profit after tax. So in the profit after tax, they have deducted the non-cash expenditure, that is depreciation. Okay, so what is a net cash inflow? Here we deal only with the cash transaction. So non-cash item to be added back again. So depreciation to be added. Then we will find the present value of net cash inflow using the discounting factor. That is, we will calculate by multiplying the net cash inflow into discounting factor, which is already given in the question. We will get present value of net cash inflow. So cash outflow occur in the initial period, that is current period. So we no need to find the present value. So present value of cash outflow is same as the cost of investment, which is given in the question. So net present value is equal to present value of cash inflow minus present value of cash outflow. Similarly, we have to find the net present value for project B also. So how we will choose the project? So we will compare the net present value of both the project. So project with high net present value should be chosen. We will take decision if they are taking decision on one project alone. If the NPV is positive, then we will accept the project. If NPV is negative, we will reject the project. If NPV is equal to 0, it is up to the decision of the management. If there is mutually exclusive project, that is we have 2 or more project, then we have to choose the project which is having highest NPV. That is we have to first rank the project with the NPV amount, then we have to choose the first ranked project. In book they have given some typical adjustment also. We will look into this also, because in exam they will frame the question using these point also. Point A they have given, it is sensitive to the method of depreciation that is adopted by the organization, because it affects the NPV we are calculating. Sometimes scrap value can be realized from the fixed asset used in the project. In such case, the amount of scrap value so realized should be considered as additional cash flow. Illustration, they have given scrap value as nil. In some cases, they will give the scrap value. In that case, we have to find the present value of scrap value. Okay, in which period? At the end of the life period. That is for project A, 4th year. Project A, if we are having salvage value, we have to find the present value of salvage value for the 4th year. And we have to consider that scrap value as a cash inflow. We have to add this scrap value also to the 4-year cash inflows. Point number C they have given, there may be a working capital investment. In question they may give working capital. So if the working capital is required additionally, it will be added to the investment amount. If it is released, then we will consider it as a cash inflow at the terminal period. Okay, if working capital is additionally needed, it is added to the initial amount. If it is released at the end of the year, it will be added as a cash. It will be calculated as a cash inflow at the terminal period. Okay, as any sale proceeds, then it should be deducted from the written down value of the block of asset. If it is the only asset, then we have to calculate the tax payable on short term capital gain or tax savings on short term capital loss. So when we are calculating the NPV, these also consider. This is not included in the illustration, but there may be a chance of including in the exam question. So we need to be thorough in these points also. The third method in the discounted cash flow method is profitability index. What is the formula for profitability index? Present value of cash inflow divided by present value of cash outflow. This is for non-conventional cash flow. For conventional cash flow, present value of cash inflow divided by initial outlay. Before starting illustration, let's see why we are using the profitability index method. If both projects having similar life, but they differ in the investment, then this method, NPV method, is not appropriate for taking the decision, because NPV is an absolute measure. It will not recognize the size difference, if any, in the investment or cash outflow between the two projects. For this situation, it is suggested to use profitability index method, which is more appropriate to take a correct decision. Okay, let's Okay, let's start on illustration number 10. X Limited is considering a new project with an initial outlay of 70,000. The project has a life of 4 years with cash inflow of 25,000, 30,000, 18,000, 16,000 for year 1, 2, 3 and 4 respectively. Calculate the profitability index for the project if the cost of capital is 10% per annum. So we have to find the present value using the discounted factor, that is cost of capital 10% for all the 4 years. Here there is no need to calculate the depreciation or anything. We will straightly calculate the present value of cash inflow using the present value factor of 10% cost of capital. So we have already seen how to find the present value of cash inflow after tax. Then we will apply in the formula present value of cash inflow divided by initial outlay, the investment amount, which is equal to 1.028. So how we will take decision? If PI is more than 1, we will accept the project. If PI is less than 1, we will reject the project. If PI is equal to 1, it is up to the decision of the management. So in the illustration, PI is greater than 1, so we have to so the project is accepted. In the case of mutually exclusive project, we have to rank the project based on the PI calculated. Then we have to choose the project which is having highest PI. Illustration 11, they have applied both the method, NPV method and profitability index method in the same question. They are showing how it differ when we choose profitability index method and when we use NPV method. If we see the solution, when we apply the profitability index method, project 1 should be selected because it is more than the project 2. When we use the NPV method, project 2 is ranked first because it is higher than the NPV of the project 2 is higher than the project 1. In this case, which project should be selected? So we have already seen the limitations of NPV method. If the investment amount is differ, if the life is same and investment amount is differ, NPV method will not be appropriate for taking decision. So in this case, we have to choose a profitability index method. So we have already seen we have already seen that life of both the project is same and the investment amount differ, then NPV method will not be appropriate for taking decision. So in this case, which method we will choose? Profitability index method. So in this illustration, as per the profitability index method, project 1 is higher than the project 2. So project 1 should be selected at last. Thank you.